Ladies and gentlemen, good morning. We will actually start this video by looking not at the 2-year note in the States, but by looking at the Euro-dollar contract, which is basically as short as you can go. 3 months on the yield curve, or very close to. One thing that is undeniable, this contract has been performing very badly ever since Brexit. This is the Brexit event, when it spiked higher, and ever since it's been a sea of red, culminating in a new low on the move on Friday after the non-farm payroll number. We are now at nearly just an eighth of 1% yield. So what this contract is telling you is that it is pricing in almost a, well, we'll call it a 90% probability of a rate hike by December this year. What is not telling you is that it is anything but a retracement to levels last seen in the middle of 2010. In any case, let's have a look at the 2-year. So since the 3-month curve has been making new highs, new lows in price, new highs in yield, the 2-year note certainly hasn't. It tried to get slightly bullish, but it got smacked on Friday straight back into this very long-term neutral zone. We've been here, it feels like forever, since March, i.e. since March this year to now, nothing, no movement whatsoever, and very little indication that we will get any movement in the near future. So basically the yield curve is, and you can see much the same thing is happening in the 5 years, smacked right back into the neutral zone. Again, that's been holding since March. It tried to make a move up in yield, but it failed. It tried to make a move down in yield, but it failed. And here we are back in this neutral zone, and it looks like that we will test, hopefully this week, these levels just below, around 121.09, 08, 10, something like that. And the same can be seen in the 10 years. Straight, actually this one is outside of the neutral zone and still inside the slightly bullish zone. And the 30 years is again outside of the neutral zone and still inside of the bullish zone. That is telling you that the yield curve is flattening by the very short end, moving up in yield, the 2-year and the 5-year remaining relatively stable, while the 10-year and the 30-year have been coming down in yield, up in price. So the yield curve is very narrow. It is sub 100 basis points, which is a relatively very shallow yield curve. We think that the movements in 10 years can actually best be seen in a chart of IEF, which is the equivalent to 7 to 10 years, as opposed to TLT, which is the 20-year plus ETF. So if you want to trade 10 years, you should always trade IEF as opposed to TLT. TLT is much more volatile. And we have marked down for you some very important support levels for the 10-year over the next several weeks. It's the area between 110.40 and 109.90. So that's a 50 tick range that we feel the contract should not break if it is to remain in a bullish posture. That is long term. Please mark those. We've marked those with, in fact, the easiest thing to do here, enable alert, and here we are. So we have marked these down with alerts. So when these levels start trading, our ears will definitely be pricked. It will be a very important turning point for the market, because if the yield curve now starts steepening, that is going to give us a signal that the market is finally beginning to normalize. You cannot get a normalization in rates without a normalization in the yield curve. What good does it do to have a completely flat yield curve out to 30 years? That means the Fed has started normalizing short-term rates, but the bond market is telling the Fed that we are not normalizing ourselves. So you can hike short-term rates as much as you like, but the effect that you are actually achieving in terms of moving the yield curve is zero, or in fact you are, let's call it pissing in the wind, because that is all they would be doing by hiking short-term rates, and that is all they have achieved so far. So it is not the Fed that can normalize the yield curve, it is only the market. The Fed can cajole it, it can talk it, it can beg, it can do whatever it likes, but so far it has singularly failed to achieve absolutely anything in terms of normalizing the yield curve. This is where price was last year when they hiked rates, right here, and this is where we are now. So we are higher in price even though the Fed has started the normalization process. The euro dollars are showing a very good probability of more rate hikes, in fact a near certainty of more rate hikes by year end, and still the 10-year equivalent is not breaking through these highs that it set many months before the normalization process started. So these are very important levels. Only when the 10-year confirms the start of the normalization process will we feel confident that something longer term is going on in the market and has changed. As far as the very short term, i.e. next week, we have a 10-year bond auction on Wednesday and we have a 30-year on Thursday, and they of course tend to be the lows for multi-days, simply because the primary dealers have cheapened up the market to take down the supply, and then a distribution process higher takes place simply because they naturally want to sell the stock they bought at higher levels. They wouldn't be primary dealers otherwise. So what do we expect to see? We expect to see tests of 131.26 to 131.22 immediately Monday, Tuesday, to get the ball rolling and get the stock at as cheap prices as one possibly can. We will be certainly covering shorts there, 131, 25, 26, 27. Those are levels that you cover shorts and then watch. If the auction takes place at above 23, you probably want to be long for a return up towards the 132.16 area. So that would be what, 3/4 of a point that hopefully you can make next week after having covered another quarter to half a point lower. What is going on in European rates and in European curves? Nothing, absolutely nothing. The Schatz is stuck in a 10 tick range. It's doing absolutely nothing. Why do we do this every week? Because we want to be certain that we're not missing some key events which some other markets are flashing. All this is naturally interconnected via exchange rates, and we want to make sure by reviewing every contract, even ones which are doing nothing at all, that we're not missing some significant movements in price or in yield curve development. So Schatz is doing nothing. Daily Bollinger Bands are compressing, probably indicating that we'll be here within this continuing 10-point range for at least another week. Don't forget that Europe is now more or less on holiday for the next 2 weeks. Bobble, same story, absolutely no difference. Look how tight this is. This is a MA's coming to meet it. RSI's nowhere inside this box, which is 60 ticks. It's absolutely doing nothing. This is still the major support at 133.22. Without us busting this range, this level, it's indicating that absolutely nothing is going on in the Schatz, and the Bunds equally still within this range that they've been in ever since Brexit. 165.60 is the important level, the one that we definitely want to be alerted by. We have the enable alert. Until that happens, you can see that nothing is happening in prices and nothing is happening in the yield curve. The yield curve is staying more or less, it's moving 1 basis point, maybe 2 basis points, but that is all it's doing. So Europe is as quiet as the grave. It's on holiday and it doesn't look like it will be doing much in the foreseeable future. Since rates are doing nothing, let's have a look what is happening to the transmission mechanism of rates, which is the Dixie. Well, it has this week managed to rally somewhat as US rates have slightly backed up, and it's still unable to bust through the line which has been the pivot point all year, 96.50. It broke above it, came back down, backed up to 96.50. 96.50 seems to attract it. Until it can clear 96.50 and start going up, there is very little going on in the dollar and the transmission mechanism, and that in itself is telling you not to expect any huge moves in the differential between rates in Europe and in the United States. When we see this consistently staying above 96.50 on a weekly basis, that will be the time to start getting either very bearish on 10-year notes, or to start getting even just very bullish on the dollar. At the moment it's quiet, it is basing. We do expect that this will be the direction of travel for the rest of the year, but it is, the timing is just not now. What is the point of sitting in a position for weeks on end if you're not going to get any reward for your risk? That is what the Dixie is telling you, and basically that is reflecting naturally in the euro, which is 60% of the Dixie. It tried to break higher, failed miserably, as we really expected it to. It can't regain this trend line, and now it is probably going to move sideways for the next couple of weeks as Europe is on holiday and not a lot is happening in the market. The one which could be interesting would be the yen. It could be making the first, could be, we're saying, we're not saying this is by any chance a certain thing. It could be making the first higher low since this whole move started. It could be argued that if now starts moving up, it will be very bullish for dollar yen. But on the other hand, we think it's much more likely that we will just stay in a range with 100 being the bottom, and let's call it 105, 106 being the top. We feel that is more likely, but certainly we feel that for next week, a move from the 100, 101 area up towards 103, 104 is more likely than a move down through 199 to new lows. That is what the technicals are telling us. That is what the yield curve is telling us. So I'm not sure that we will be playing it in any size, but it gives us an indication more about Nikkei than anything else. And finally, let us have a look what is going on in equities. This is a weekly chart of ES. To be able to better see this area, let's enlarge it. So we have 1, 2, 3, 4, 5, 6 weeks of higher prices. The price retested this breakout zone in the on the Bollinger Band around the 40 level and went straight back up. The Bollinger Bands next week will be somewhere around 21.85. But overall, if you remember that 3 weeks ago we sold 21.68 to against XLV and XLK, the market has done what we really expected, i.e. nothing. It is now not even 0.5% higher than it was 3 weeks ago. This indication that it can't go down is certainly longer term bullish, but for the time being it's saying do not chase price higher, wait for dips and buy those if you're bullish. The same thing can be seen in the dailies. We have the market basically going back to the top of the Bollinger Bands, which are compressing. We can see this better here. Just sideways, sideways, sideways. We don't feel that this is really a break, which is just a test of the top. With the Bollinger Bands here, we expect the market to do absolutely not a lot, and probably certainly for the early part of next week stay between this 2160 to 2185 area, let's call it. I mean, that's less than 1%. We might be wrong, but we think that this market is on holiday as well for the time being. If one is bullish this market, we feel that a much better alternative to being long is to be short of volatility. We have the contract, the volatility contract expires, the August volatility contract expires on the 17th. So that is 7 trading days after Monday. and we have a quite a steep curve that the contract has to travel. If we're right and volatility just stays where it is or even slightly declines, you will pick up, well, nearly 3% here in volatility for the next 7 trading days, as opposed to sitting in ES and carrying that risk. We certainly, for our part, have been short this part of the curve and long this part of the curve, feeling, in fact, just long December, and we keep on going in and out of those positions, and it's certainly profitable. It's making 10 ticks a day. So we prefer to play volatility at the moment rather than play ES. And as you know, ES we are playing by being short against the individual sectors that we feel are more bullish. All the other equity indices and markets are showing more or less the same picture. This is the Wilshire 5000, so a very broad index. It has broken decisively above its previous highs. It is, though, right at the top of the Bollinger Bands, indicating that any move higher is going to be slow and protracted and be in the terms of less than 0.5% to 1% over the course of the next 4 or 5 days before any dip which is buyable. So again, this is telling you don't chase price higher. There is no point. Much the same thing is being shown in emerging markets, right at the top of the Bollinger Bands, above this, this resistance level. But we have a variety of resistance levels. Well, here we have one at 36.77 from the previous low back in July of last year. So again, even emerging markets, the market's telling you don't chase me, there's no point, there will be dips back. If I'm bullish, I will wait for a dip back towards this center line to buy it. I see absolutely no rush to buy the market up here, and we can see the same thing in just about every market that we look at. It's just the same everywhere. It's right at the top, right against major tops, major resistances. Bollinger Bands are making it very difficult for the markets to move much higher. Now, this is a monthly of the NQ, right up against monthly resistance. If we take this down to weeklies, again, let's zoom in and you will see how much is getting overbought. 1, 2, 3, 4, 5, 6 straight weeks of up and beyond the Bollinger Bands, which is telling me that the likelihood of this market making substantial new highs is almost zero. It's moving much more than ES is moving, but that makes sense because high beta stocks, your Googles, your Apples and stuff like that, is beginning to move much more than ES and catch up, because they're still nearly unchanged on the year. So we'd rather be long of NQ on drops, but that is the position we have. We are short of ES and long of XLK, so we will stick with that position and add to it on significant drops. I mean, we would really love to buy a drop now in the NQ towards 4,600. That is the area that we would like to first buy it, the first significant dip that we feel that is buyable. At the moment it's, well, nearly 200 points above it, which is what, nearly 5%. So as you can see, we really don't wish to chase price higher here. We really don't see any point. Even on the dailies, NQ now, well, it could make marginal new highs, but that's about all that we can expect from it. It feels like the market is at extremes, and during this holiday period it's extremely unlikely that it will make substantial moves higher. It might be a grind, but that it's all gonna that all that it will achieve. The one that we feel is potentially more rewarding than the US indices is the DAX, but again it's a longer term play. We rejected the retest of the 200-day moving average and went straight back up into this very important downtrend line with these very important levels around 10,465 up to 10,512. This is the cash chart, don't forget. Until we break those levels, we are likely to be hitting our heads against, even though we might break the downtrend line, we are likely to be hitting our heads against those levels. But once we've cleared them, the path higher is much clearer than in ES, and therefore we feel that there is much more longer term potential of being long the DAX and even the stocks than there is in ES. On a daily chart you can see how much more room we have in stocks even than in DAX, and really this is a function of the banking sector in the EU. It has been beaten down so badly that this index has been unable to catch up and with DAX and ES. If that now starts turning, we could see very rapid moves towards the 3,150 area. So on a risk reward basis, if one is bullish, it's certainly better to be long of stocks rather than ES, and for added safety maybe DAX. So maybe a butterfly, long a few DAX, long a few stocks, and short some ES. But the one we feel probably has the most potential, because we are now bullish on dollar yen for a couple of percent, is actually the Nikkei. Again, the Nikkei we feel has tested the lower levels, held them beautifully, and now it certainly could move up very easily towards 17,000, consolidate a bit, and then test this line somewhere around just below 18,000. So again, the risk reward is much better in Nikkei, in DAX and stocks than it is in ES, in our view. We might be wrong, but we see far more room in those contracts rather than ES. One final chart for the equities, especially for the American ones, is this one with the volatility ratio of the INX. Look how overbought it is. It is basically as high as it has been, well, ever. And statistically it tends to show that the possibility of a dramatic fallback is very much increased. Although this chart per se looks quite bullish, we have cleared now the previous highs. and settled above them. This kind of ratio tends to imply extreme complacency in the market. It is really a warning sign. We will definitely not be chasing ES up here. The risk reward is extremely bad. We are much more likely to be sellers of puts in Nikkei and DAX and stocks rather than buyers of ES. Those are just the risk reward parameters which are best. It is better to make less money in a safer way than put capital at risk when this kind of ratio is at these levels. This is the highest level of complacency that this index has recorded, well, ever. It might be saying something significant, which is that, oh, it's absolutely certain to go up, but we would rather not risk it, and certainly not with VXX trading where it is. Again, you know, VXX is making new lows. This is nothing new, but is so extremely oversold that any kind of 20-point move in ES is going to make it, you know, make for a 30-40 tick, very rapid move in VXX, which in percentage terms, when it's trading, below 10, is quite a large move. So it is. What can we say? The VXX is confirming the move upwards, but the level of the indices of the ratios is so high that we feel, and plus the fact that the Bollinger Bands on the weekly and the monthly, we're right on top of them both. We just feel that the risk reward to higher prices and to chasing higher prices is extremely bad. Extremely bad. We would again rather be short in terms of if we wanted to be long the market, we would rather be short of even the front month volatility, because at least in that case we have a cushion. Don't forget, let's try to explain that better for you. Here we have the volatility index against which it will settle. It closed on Friday at, let's call it 1140, while the front month VXX closed at 1290. Well, that's 150 points of convergence that has to happen over the next 7 days. Now, if the market starts falling, if ES starts falling, this index needs to go up 150 points before you start losing any money. Now, can it go up 150 points? Yes. Can it go up 200 points? Yes. Can it go up 300 points? Yes. But you will lose 150 points less. So basically you will be shorting, it's the equivalent of shorting this market. So 1290 is here. Where is it? Right there. So basically you will be shorting, let's make it, it's the equivalent of shorting the market here. Can the market go higher up to 15? Of course it can, but your loss level is going to be so much less by being short of volatility than being actually long of ES. Last time we were here, ES was trading in the 50s. So basically it's the equivalent of being long of ES in the 50s. So what is that saying? That is, why would you buy ES at 2177 when you can actually be structurally, artificially long of it in the 50s by being short of the front month NQ? You might end up losing less money, but the level of safety is so much higher that we feel that it's almost a slam dunk to be short of front month volatility rather than long of the ES. How dangerous things are beginning to be is actually confirmed by all the fundamental studies that we follow. As you can see, this is a monthly chart of the forward valuations in the S&P 500, and basically it's done absolutely nothing for a couple of years. It up down, but in effect nowhere. Forward valuations are basically just going sideways. And the last time that the forward valuations were at this level, we were, well, let's call it here, we were trading just around 2000. Now we are trading at 2180. Yeah. Can it go higher? Of course it can. I mean, look at this period in between, say, call it 96 and 2000. But that was, when the market went to nearly 25 times valuations. But that was a period of intensely rising forward earnings. And it was also a period of easing and monetary addition by the Fed. Don't forget, this is the time of the Asian crisis and long-term capital management, when the Fed actually made the huge mistake of adding large liquidity and easing, and therefore causing this part of the bubble. This bubble naturally, and I remember very well, because we just couldn't make any money for best part of a year and a half, because we refused to buy these valuations. We just refused, and it kept on going up in our face. So can this go up in our face? Yes, it can, but we'll still refuse to buy it, and we will be doing other types of trades, like the volatility trade I just told you about. There are always safer alternatives to being long, blindly long of ES. And look what happened afterwards. The market came straight back to 15 times forward earnings. Thank you very much. And then it started going back up. So if you're patient, and by that I mean at least 1 or 2 years, you will see again at some stage forward earnings, the market trading at 15 times forward earnings, and that is below 2000. In fact, it's around 1900. So you will see it. And here we are, right on top of the 17 times line. It is very, very unlikely to move by percentage points. It's much more likely, if it stays bullish, this study is telling you that it's going to move 0.25%, 0.5% a week, with significant retracements down. Sector analysis, unfortunately, has not changed in the slightest. Discretionary is still probably a better bet than staples. Staples are still very extended even after this fall. Yes, they might retrace, and this is what you have to think about. How is the overall S&P 500 index going to advance? Which sectors are going to carry it up? Well, consumer staples might go back up towards their highs, and the discretionaries might make a new high, but they're not going to go very far, because now that earnings season is almost over, these are and the new guidance is being issued for the next quarter. What this is telling you is that the guidance isn't that good, and that the companies themselves do not expect that much more business. Well, with GDP growth of 1%, how can they? So this is a sort of steady as she goes kind of chart, as is probably this one. So the energy, we keep on telling you, just avoid. I mean, just avoid. It's going to take years for this thing to normalize, and the odds, not the odds, the chances that this has another significant leg down are much better than it has a very significant leg up. This kind of disconnect is going to take years to re-establish from a fundamental point of view, so we absolutely avoid energy apart from the short side. We're very impressed by the fact how little it has fallen, with oil down, well, 20% from 50 to 40. But still, we don't trust it. We just do not wish to buy. This is really a market where you can do some option plays, but certainly not outright, because this disconnect is so fundamentally wrong to us that we would not put significant amounts of capital at risk with this kind of disconnect. Now, these prices have started rising, but they need to rise so much more while this index just goes sideways for it to start making any sense, that the odds of us doing anything significant in 2016 or early part of 2017 in this ETF, XLE, almost zero. The financials, well, we bought, we tweeted that the system went long-term long of JPM. We let it do its own thing. It's got a pretty tight stop, so off you go. But we just feel from a fundamental point of view that it's very, very, very hard to get very long of XLF at these levels until these price lines start actually trending significantly higher, and at the moment they're just not. They are lower than they were at the beginning of 2015, and so is the market, ever so slightly. So the danger of accidents, 3, 4, 5% sudden drops in XLF are actually there. What XLF might be anticipating, if it doesn't retrace, is higher rates in the United States. But there are other ways, more profitable ways to play that. Just short bonds, short TLT, short IEF, rather than continually running the risk of being long a market like XLF at these levels. We feel the odds here are very bad. Healthcare, as you know, it's showing very few signs of actually topping off. We feel that this test of this 900 level is almost a given. Whether it takes a week, a month or two, we don't particularly care. We fundamentally like this sector. It is the only one which has very nice, continually rising expectations of forward earnings, and it is the only one which has done absolutely nothing wrong since 2008. It is the only one that never had very much of a lowered expectation throughout the crisis. It's a defensive sector, so we feel it'll certainly outperform if we have an accident overall in the index. Industrials, well, they broke out. They've retested this line, as they should, because this is just going sideways. So the potential for higher prices in industrials is again limited. 1, 2, 3%, but that's not a trend in a sector. That's actually a reaction. Tech, yes, has some room. That's why we're long of XLK, and while we're long of the healthcares. Materials, much of a muchness, not really something that we're enamored of. And telecoms, well, yeah, maybe a little bit, but not that much. So overall, utilities. Now, utilities could get absolutely slammed if now we start looking for higher rates. and probably those will be the canary, one of the canaries in the gold mine, in the coal mine. Gold on my mind. This is quite a, potentially bearish pattern, but we definitely would want to see it break below this 18 times line, and that would give us a signal that yes, even they are giving up. So there you have it. What sectors are going to drive the S&P 500 much higher? Well, unless they all start going to silly valuations, the S&P just cannot progress. So it is to us a market where it's much safer to be long of individual sectors rather than the index itself, where it's safer to be long of maybe DAX and stocks and Nikkei rather than the S&P 500, and where it's probably even safest of all to be short of volatility, because at least you have a cushion that can absorb any sudden drops in the index. That's all we have for you this week. Have a good trading week. We think it's going to be quite slow as the holidays have started in earnest, as have the Olympics. So we shall see what happens. We are still here, and we will be with you tweeting away all of next week. Thank you very much.